Hi everyone, my name is Colby Wright, and on behalf of the entire Bounce Financial Training team, I would like to welcome you to today's module on the subject of forecasting costs. Let's dive right in, but before we get into the details of how to forecast expenses and costs, I want to motivate the subject for just a second. You'll remember from in-class training that we talked about the challenge that you face as an analyst. Ultimately, you have to make buy, hold, and sell recommendations on specific equity securities. That's going to involve executing a valuation analysis. You have to estimate the intrinsic value for the stocks you're covering. We had a discussion in class about how the value of any asset should be a function of the utility that it provides. Thankfully, when we're valuing financial assets, there's only one type of utility that they provide. And that one type of utility that they provide is future cash flows, or I should say expected future cash flows. So in order to value a financial asset from a very high level, what we want to do is forecast those expected future cash flows and then somehow find a way to price those expected future cash flows. Well, remember, we also talked about the fact that given a choice, we would always prefer cash flows that are sooner and more certain to cash flows that are later and less certain. So what we're going to do, again, very high level, in order to value a financial asset is map out or forecast the expected cash flows, and then we're going to penalize. The word we actually use is discount. We're going to penalize or discount those cash flows, and the penalty and the discount will be higher if the cash flows are further in the future or less certain. So that's sort of a high-level theoretical version of how we approach asset valuation. Let's talk a little bit more about the specific system that we use, especially if we're talking about a discounted cash flows model. If we're doing a discounted cash flows model, it's all going to begin with the sales forecast. We have an entirely separate module that focuses exclusively on forecasting revenue that I would direct you to for that topic. Once you forecast revenue and forecast sales, then you're going to use what we call the percentage of sales forecasting method to forecast expenses, and also you can use that method to forecast the other financial statements. From that, you're going to create what we call pro-forma financial statements. From the pro-forma financial statements, which simply means forecasted or future financial statements, you will then estimate the free cash flows to the firm. And once you've estimated the free cash flows to the firm, you can carry out your discounted cash flows valuation analysis. Now, as a simple reminder, how do we actually calculate free cash flows to the firm? Free cash flows to the firm are operating cash flows minus net capital spending minus increases in net working capital. How do we calculate operating cash flows? It's EBITDA, earnings before interest, taxes, depreciation, and amortization, multiplied by 1 minus the tax rate. In other words, it's after-tax cash flows from our main operations. Net capital spending is, if you can get it, just net capital spending. Sometimes you have to back into it by taking ending net fixed assets minus beginning net fixed assets plus depreciation. The increase in net working capital is straightforward. It's ending net working capital minus beginning net working capital. The bottom line is this. If this is our system, what you see on the screen, if this is our system for actually getting to a discounted cash flow analysis, and if this is how we calculate free cash flows to the firm, you must have a complete set of pro forma financial statements in order to estimate free cash flows to the firm, which you will then discount or penalize to get your intrinsic value. If that's the case, we need to know and be able to forecast all of the financial statements. Well, again, we have a separate module talking about forecasting revenue, which is really the linchpin in all of this. Today, what we're going to focus on is just forecasting costs. I'll touch a little bit on the balance sheet, not going to talk about the cash flow statement at all, focusing exclusively on forecasting the income statement. So let's go ahead and move forward. Let's talk about the steps to the percentage of sales method for forecasting costs. Again, we're assuming that you kind of already have your sales forecast, although I've embedded that in the steps. We're focusing on how you forecast the costs and the expenses. Step number 1 is we want to identify the financial statement accounts that we think should vary proportional to sales. In other words, if sales are projected to go up 10%, what are the other accounts on the financial statements that we think will probably also go up 10%? Second step, for each account that you believe will vary proportional to sales, you need to calculate that account's value as a percentage of sales on past financial statements. So all we're saying is in step 1, figure out which accounts you think should move with sales. In step 2, go look at past financial statements and figure out for each account that you think should vary with sales, what percentage of sales has it been in the past. Step 3, this is where I've embedded the sales forecast, so you do at some point need a sales forecast. Step number 4, now that you have your sales forecast, what you can do is you can estimate the value, so you're forecasting now, estimate the value for each account that you identified in step 1 that you believe should vary with sales, and the way you're going to forecast that account is by multiplying your forecasted revenue by that account's percentage of sales in past years, which you calculated in step 2, and I'm going to give you a very thorough demonstration of this in just a second. Step number 5. Judgmentally estimate any financial statement accounts that do not vary proportional to sales. I will also give you a very in-depth demonstration of one of those accounts. So then step 6 is that you need to calculate the external funds needed or projected surplus. All we mean there is once you go through steps 1 through 5, your balance sheet won't balance. You'll either have more assets than liabilities and equity, in which case you're going to have an external funds needed. You have more assets than you have funding. Or you're going to have more liabilities and equity than you have assets, in which case you'd have a surplus. Once you figure out the problem on the balance sheet, either a deficit, external funds needed, or a surplus, then step number 7 is you need to determine your plug variable. So for instance, let's say that you forecast they have more assets than they have liabilities or equity. You're going to have to decide, will they issue more debt? Will they issue more stock? Or will they reduce their dividends? You have to use one of those 3 methods or a combination of those methods to bring the balance sheet into balance. So what I would like to do is I would like to kind of walk us through the steps when it comes to the percentage of sales forecasting. And I want to begin by simply reminding you that step 1 is you have to identify which accounts vary with sales. So one of the key questions you're going to face is, I'm looking at an account, for instance, cost of goods sold on the income statement. Do I think that this account should vary with sales? And I'm going to give you 2 questions to ask to try to figure that out. Question number 1 is, what does your business acumen tell you? You're analysts. You understand this industry. You understand business in general. So for instance, if you're looking at the income statement and you're thinking about cost of goods sold, does your business acumen tell you that that expense line item, generally speaking, would vary with sales or would be uncorrelated with sales growth? My business acumen tells me that if there's any account at all on the financial statements that are going to vary with sales, it's going to be cost of goods sold. So the first thing is use your business acumen. What does your intuition tell you? If it's not clear, there's a second question. What does past data suggest? An account that varies with sales should be a fairly constant percentage of sales over the past 3 or 4 years. So one of the things you always want to do when you spread the numbers, when you start looking at financial statements, is just calculate every line item as a percentage of sales for the last 3 or 4 years. And if you ever see a line item and you're not sure, you're like, man, I don't know, I'm not sure if this account should vary with sales, just look at the historical trend and that should give you some insights. And again, I'm going to give you a demonstration. Once you've asked those questions, then it's simply, well, what do I do? Well, if the account does vary with sales, then you're going to use the percentage of sales method to forecast that account. If you don't think that line item will vary with sales, then you're going to have to use your judgment. And again, I'm going to give you a very, very thorough example on that. So let's dive right in. The example I would like to use today is Carnival Cruise Lines. I've spent quite a bit of time following this company, learning about this company. So let me first off just spread the numbers for you. A few observations here. First off, notice that I've got the last 4 years worth of financial statements pulled up here, fiscal years ending in November of 2013, 14, 15, and 16. Please notice that what I've done just to the right, in the next 4 columns to the right, is I have calculated each line item's percentage of sales for each of those 4 years. So for instance, in the year 2016, you can see that the commissions, transportation, and other expenses line item in 2016 was 13.7% of total revenues. That's how to read this spreadsheet. Now, why does that matter? Some of the line items we're sure are going to vary with sales. Some of them we're not sure. And if we're not sure, one of the things we're going to look at is past trends. So let's start talking about how we're going to forecast these expenses for Carnival Cruise Lines. Now, just a disclaimer, this module is not focused on a sales forecast. So I've already put in my sales forecast. You can see my sales forecast for 2017 on the far right hand of the screen. My sales forecast is $16.6 billion. Let's start working through the expense items. That's our focus today. Commissions, transportation, and other expenses. This seems to me to be a line item that intuitively should vary with sales, and it's been in a pretty constant range. Over the last 4 years, this expense item has been between 13.7 and 14.9% of sales. So I decided that for my forecasted year of 2017, I'm going to hold last year's percentage of sales constant. So I'm going to apply a 13.7% percentage of sales to this account in 2017. Onboard and other expenses is also another expense item that for me intuitively varies with sales, and you can see it's also at a very constant percentage of sales in the past. So again, I'm applying a 3.4% percentage of sales to that line item. Payroll and related expenses has also been pretty constant as a percentage of sales, so I'm rolling that forward and I'm using 12%, which is the average of the last 2 years. Fuel expenses. This one's a little bit challenging. Fuel expenses should be correlated with sales, but not perfectly correlated with sales. Whether or not we fill up the boat, we're gonna actually have to pay for that gas. The gas will be somewhat dependent on how much weight we have on the ship. So there is some correlation, but also gas prices are not only gonna depend on how much fuel we put on the ship, but on fuel prices. So this one's a tricky account. Let's look at what we see in the past data. You can see that going back 4 years, fuel has been 14, 13, 8, and 6% of sales. For simplicity's sake, I took the average of the last 2 years, which is 6.8%, and we're gonna use that. So I'm going to apply a percentage of sales to get our fuel expense, but we're acknowledging, we're raising the white flag, hands up. That's probably a bad assumption, but for purposes of our demonstration, we're gonna roll with that. Okay, next is food expenses. Food expenses should absolutely vary with sales. It's been very constant over the last 4 years. So I'm using the average of the last 2 years. I'm not showing you enough decimal places here, but I'm using the average of the last 2 years, so it's roughly 6.2%. Other ship operating expenses has also been fairly constant, so I'm using the average of the last 2 years. And then tour and other expenses should also, my intuition tells me, vary with sales. So basically, I've decided that for all of the operating expenses, I'm applying the percentage of sales approach. And for most of those accounts, I'm using the average of the last 2 years in terms of determining what the percentage of sales actually is. So then all I do is for each account, I take that percentage and I multiply it by my sales forecast. So for instance, commissions, transportation, and other expenses. How did I get my 2017 estimate for that expense item? I took the 13.7%, which is what the percentage of sales has been for that account the last few years. I take 13.7% and I multiply it against my revenue forecast for Carnival Cruise Lines for 2017, which is $16.6 billion. 13.7% of $16.6 billion is $2.278 billion. I apply that same methodology for all of those operating expenses. I do the same for selling and administrative expenses because it looks like it's also been a fairly constant percentage of sales. However, this is where we now move into the accounts that are going to require some judgment. Specifically, we're going to have to talk about how we get depreciation and amortization expense. We're going to have to talk about interest income, interest expense, gains and losses on fuel derivatives, and taxes. These are all accounts that are going to require judgment. I'm only going to go in depth on one of those because we're trying to keep this module to under an hour, but those are all accounts that we would have to apply judgment to. Before we do that, however, I want to take a quick digression and talk about something called EBITDA, earnings before interest, taxes, depreciation, and amortization. Matters immensely. Why does it matter? Because remember, ultimately we have to forecast free cash flows to the firm. Free cash flows to the firm, operating cash flows minus net capital spending minus increases in net working capital. How do you get operating cash flows? EBITDA times 1 minus the tax rate. So you can't get free cash flows to the firm without operating cash flows. You can't get operating cash flows without EBITDA. So we've got to understand EBITDA. That's not the only reason though. EBITDA is a nice income measure for making apples to apples comparisons. You never want to just compare net income or even income from continuing operations. It's important to get to EBITDA because this is the best cash flow measure of income that we have. So it's also good for benchmarking. So go back to our financial statements in 2016 and notice a couple things. Operating income is roughly $3 billion. Depreciation and amortization was $1.7 billion. So how would we get EBITDA? We would just add that depreciation and amortization back to the operating income, and that gets us to our earnings before interest, taxes, depreciation, and amortization. Now, what if you look at the financial statements and it doesn't have depreciation and amortization on the income statement? This is actually very common that companies will not separate out depreciation and amortization on the income statement. No problem. You can find it in other places. So here's what you do if you can't find depreciation and amortization on the income statement. First off, you got to locate, or you might have to calculate EBIT, earnings before interest and taxes, on the income statement. You're going to need that because you're going to add depreciation and amortization back to that. Then go to the cash flow statement. Almost always you will find depreciation and amortization on the cash flow statement. If for some bizarre reason you don't see that, go to the footnote on property, plant, and equipment and intangibles, and you'll be able to find depreciation and amortization. Then it's the same exercise. Take your earnings before interest and taxes and add back your depreciation and amortization, and you'll have EBITDA. Okay, so now that we've established how to calculate earnings before interest, taxes, depreciation, and amortization, which I hope never to say again, it's just going to be EBITDA from this point forward. Once we've done that, let's jump back into our exercise. Remember, what we're trying to do is forecast costs today. We've already kind of worked through the simple stuff, which is the percentage of sales accounts. Now we want to get into the tougher accounts that require the use of judgment. And again, I want to give you a very thorough demonstration on that. So let's go back to the financial statements. The first account that we're going to get into is depreciation and amortization, and that's the one that I want to do the thorough demonstration on. But I'm also going to insert a few kind of immaterial accounts here. So you'll notice that I just filled in for Ibero goodwill and trademark impairment charges. That showed up in 2013. It hasn't showed up since. I'm assuming we're not going to see that again, so I put a 0 in for that. Also, notice interest income. It's been very small. It's less than a 0.1% of sales. I'm going to call this immaterial from my auditing days. It's just not a big enough account for us to spend a lot of time on. Side note, as an analyst, this is something you've got to get very good at. You want to have as much precision as possible, but you got to work as quickly as possible. It's not like you can stay up 24 hours a day, 7 days a week and do this. You got a lot on your plates. So you've got to move efficiently, which means there's a trade-off between precision in the forecasts and moving efficiently. If something is this small, it's immaterial, it's not going to impact your valuation. That's not going to be the difference between a buy and a sell recommendation. So I'm just going to keep it steady from what it was last year at $6 million. Interest expense and other income, however, we are going to have to spend some more time on. And then please notice that gains on fuel derivatives, gains and losses on fuel derivatives, there's no good way for me to predict that. We would have to spend a lot of time getting into the weeds of what their derivatives contracts actually look like, and I think we would struggle to get that data. Then we would have to try to make forecasts about where fuel prices are headed. I just don't have any confidence that we can precisely or accurately estimate that account. And I would also say it's fairly immaterial if you look at the size of that account. So I'm going to put it at 0 because on average that should be 0 if you have an effective hedging strategy. Then if you aggregate it over the long run, it should be 0. So I hope you're following some of my logic. Some of the accounts I'm just calling immaterial. Some of the accounts I'm saying, look, there's no way for us to forecast that, and it is immaterial. So I hope you can see there's a few accounts we're kind of waving our hands at, but that's not a problem. We've got to be efficient as we seek precision. Let's go back, however, to depreciation and amortization expenses. This is going to require some work, some heavy lifting on our part, but we need it. Not only do we need it for EBITDA, we need it for net capital spending. Remember, free cash flows to the firm, operating expenses, minus net capital spending, minus the increase in net working capital. So this is an account that it's worth spending time on, especially for Carnival Cruise Lines, because they have huge property, plant, and equipment line items on their financial statements. So their net capital spending is going to be big, and their depreciation amortization is also big. So let's jump into that. When I look in the financial statements, specifically under management's discussion and analysis and under their business, actually this is section 2 of the 10K, that's where I got this from. So this is just the analysis of their business. They actually outline in section 2 of their 10K all of the ships that are either under construction or under contract to be constructed. This is what I'm going to rely on heavily to try to come up with my net capital spending, my CapEx waterfall, if you will. So this is going to be the basis for my CapEx waterfall. Let me tell you what I did with this. I took this information, so these are all the ships that are under contract to be constructed, including their capacity. And what I did is I mapped out a works in process and a completion schedule for all of their ships. I'm going to make some key assumptions. I'm going to assume that on average it takes 3 years to build a cruise ship. Also, I went online and I found some data. Their most recently fully completed cruise ship was the Carnival Vista. The Carnival Vista cost $800 million to build, and its capacity is 4,683 passengers. I'm going to use that data to try to infer the cost of each of the other ships. Now, one of the things we could try to do is actually go try to find the precise cost of each ship. You're going to struggle to do that. There is some data out there, but it's not readily available. So I'm going to use the known cost and capacity of the Vista to try to estimate the cost for the rest of these. And basically what I did is I just divided the cost by the capacity. So I came up with a per passenger cost to build the ship. And then I multiplied that per passenger cost to build the Carnival Vista against the capacity for each new ship being built. So what you can see here in this schedule is for each ship, I've mapped out what year it gets completed, and then the 2 years before that, I show that it's in process. I show what the capacity is for each of these ships, and then I also show what the estimated cost is using the methodology that I just outlined for you. Now what I'm going to do is I'm going to take the estimated cost of each of those ships and I'm going to spread it out over the 3 years that it's under construction. So that's the next schedule that you're going to see. That's just me mapping out the estimated cost for all the ships over the 3 years that it's under construction. So for example, the first row, Carnival Horizon, you can see that the total estimated cost for the Carnival Horizon based on its capacity relative to the recently completed Carnival Vista, estimated cost is $666 million. I spread that over 3 years, and in each year that's roughly $222 million that the company is incurring in capital expenditures, net capital spending. Then what I do is I add up for each year at the very bottom of the schedule the total CapEx for ships in each year. So in 2017, the total CapEx for ships, we expect it to be roughly $2 billion. So then what I do is I've put together a CapEx waterfall. In 2016, at the end of the year, we know from the balance sheet that they had gross ships and ships under construction of $44.8 billion on their balance sheet. So that's an actual number in 2016. That's going to need to be depreciated. That existing PP&E on our balance sheet has to get depreciated. But in 2017, we're estimating that they're going to add about $2 billion in new build. That's going to also need to be depreciated, so that's going to remain in the gross fixed assets moving forward. In 2018, we're anticipating that they will add $2.7 billion, in 2019, $2.7 billion, in 2020, $2.3 billion, and in 2021, $1.2 billion. So then I can use this to get to my depreciation schedule. So I'm going to refer to this as my CapEx waterfall, but this is just for the ships. They actually have other types of assets that we have to worry about. So the next screen is going to take what you see here, my CapEx waterfall for just ships under construction, and then I'm going to do this for the other types of fixed assets. So you can see at the very top, that's what you saw on the previous screen. That's my ships CapEx waterfall. The next one is land buildings and improvements. I went back and looked at trends. This really hasn't changed much. It doesn't look like they're buying a lot of land and they're not doing many improvements. So I'm going to keep that constant for now. That's something we could go and consider more. But I would also point out, relative to the ships, this is a very small number. Ships, we're talking $40 to $50 billion. Land, we're talking $1 billion. So what is that? 2%? I don't want to call it immaterial, but I'm not going to spend nearly as much time worrying about that account. Then at the bottom, other long-term assets. Again, this is only 3% relative to the total PP&E. So I don't want to spend a ton of time on this, but I did notice there's a pretty clear trend. They are adding. So you'll notice in my CapEx waterfall for other long-term assets, I'm adding about $200 million a year. But with the ships, we're talking about $2 billion. So what I do is I create a CapEx waterfall, and if you look at each of those tables, what I do is I estimate what I think the gross fixed assets will be in each of those categories. So for instance, in 2017, look at the top, my estimate is that there will be about $47 billion in ships and ships under construction. For land, buildings, and improvements, there will be $1.086 billion. And for other long-term assets, there will be $1.79 billion. I add those three up. So at the end of 2017, the total gross PP&E that I estimate on the balance sheet is $48.787 billion. So when I do the balance sheet, that's going to be my forecast at the end of 2017 for total gross PP&E. Now, at this point, you have a choice. How do I want to think about doing the depreciation? So I'm going to use a very simplified method when it comes to actually estimating depreciation expense. We have our estimate for gross PP&E for 2017. We know that last year depreciation expense was 3.66% of gross PP&E. So I'm just going to multiply my estimated gross PP&E in 2017 against 3.66%. Again, for those of you that don't like that method, grit your teeth for a second and I'll show you one that's perhaps a little bit more appealing to you when we get to the practice exercise later on. So I take that $1.82 billion that I get from multiplying 3.66% against my gross PP&E estimate of $49.787 billion in 2017. I take that $1.82 billion of depreciation expense, I move it to the income statement. We can do the same thing for amortization. It turns out that Carnival Cruise Lines doesn't have much that it's amortizing. It's almost entirely depreciation, so I feel kind of comfortable just moving forward. Okay, now we've got other accounts that we've got to deal with, and I've kind of already filled them in here, but I want to show you how we're going to approach those other accounts. But before we do that, I want to talk about what could we do differently? What could we do better? So I just showed you how to get one expense account forecast that requires pretty considerable judgment. That was the depreciation expense account on the income statement, which required us to forecast gross PP&E using a CapEx waterfall. That's a pretty involved process, but not bad. The data is usually out there and you can execute it. So what could we have done better? I think definitely we could have tried to find a more precise per ship cost estimate. Remember, the cost estimate I used was based on the recently completed Carnival Vista, but we could have gone and tried to find what the actual cost is for the other boats. Something you could do. We could also be more thoughtful about the other capital spending lines, land and building improvements and other assets. But again, those are such small line items, I wouldn't spend too much time on that. We could take into consideration asset disposals, ship retirements. You could try to sift through the financial statements, figure out what ships might be on the docket to be retired, and think about getting asset disposals into your CapEx waterfall as well. And then we could be more precise with our depreciation schedule. Like I said, I used a pretty crude method to estimate depreciation, although it's usually not bad. And again, when we do a practice exercise, I'll show you a little bit more sophisticated method. But let's jump back in and finish the exercise. Interest expense. When you look at the percentages in light blue for 2013, 14, 15, and 16, what I've done is I've taken interest expense as a percentage of total debt. And you can see the last couple of years it's been 2.1 and 2.2%, which is very, very low. So I'm going to make the assumption that if I can estimate debt for 2017, that their interest expense is going to be roughly 2.1 or 2.2% of that. So what I need to do then is need to try to figure out how much debt they're going to have. Then I'll multiply it by the 2.2%. I'm not going to spend a lot of time on this. I would spend more, but I've already demonstrated to you how to use judgment to get your depreciation expense. So I feel like I've given you a demonstration, but I want to finish the exercise here. So what I have to do is I have to actually forecast the balance sheet. So what you see now is you just see the assets on the balance sheet. For all of the operating assets, the current assets, I've just used a percentage of sales method. If you're doing this completely and thoroughly, you would actually forecast the cash flow statement to get your estimate of cash. I shortcutted it here and used the percentage of sales. Again, today's module is on cost, so that's why I'm speeding through this. But anyways, I've forecasted current assets using percentage of sales approach. The fixed assets you should recognize. My forecast of fixed assets is coming from the CapEx waterfall that I created earlier. So that's exactly where I'm getting all of the numbers in red is from my CapEx waterfall. I'm assuming goodwill is going to remain constant. Other intangibles will remain roughly constant. And other assets are also going to remain fairly constant. In fact, I think I did percentage of sales, but they're roughly constant. Okay, now what we have to do is forecast the liabilities. You can see that short-term borrowings I have at 0 and the current portion of long-term debt I have at $2 billion. That's straight from the footnotes. If you go to the debt footnote, you will see this. And you can see that there's no short-term borrowings coming due in 2018, but there is a current portion of long-term debt of $2.071 billion in 2018. So whatever I have to pay in 2018, that's going to be my short-term or the current portion of long-term debt at the end of 2017. So that's why you see $2.071 billion as the current portion of long-term debt at the end of 2017, because we're going to pay that off in 2018. Then I've just gone through the rest of the accounts. The current liabilities, I used percentage of sales approach. For most of the equity accounts, I just kept them constant, except for retained earnings. Retained earnings is going to increase by whatever my forecast of net income is, less dividends. So I forecasted my net income on the income statement, subtracted out what I think the dividends are going to be, and then I took so that's going to be my delta in retained earnings, right? The difference between net income and dividends. It does create a circular problem, so you have to use iterative calculations when you're doing this in Excel. What I mean by that is my income statement is going to change if I change the debt on my balance sheet. So my income statement will change because interest expense will be dependent on the debt on my balance sheet. But then the income from my income statement is going to affect the retained earnings on my balance sheet. So what happens is it creates this circular reference problem. You just need to click the iterative calculation option in the formula section of Excel. So what I did is I filled in all those accounts except for total unsecured long-term debt. So I forecasted all the balance sheet accounts either using judgment, using my CapEx waterfall, using footnotes. I used all the resources at my disposal in order to forecast the balance sheet. But I left the debt number blank because I chose that as my plug figure. Remember I said when you first do this, your balance sheet won't balance. So then what I did is I figured out the debt number that was necessary to balance the balance sheet. That's how I forecasted that long-term debt. So my balance sheet balances. Now I have a forecasted total long-term debt. I'm going to add to that the current portion of long-term debt. So that's going to be roughly $12.5 billion. And I'm going to multiply that against 2.2%, which is what we said the average interest against total debt has been over the last couple of years. So I take that roughly $12.5 billion, I multiply it against 2.2%, and that gives me an interest expense forecast of $232 million. Last thing left is taxes. So for cruise companies, taxes are a little bit buggy. Because they claim to get most of their revenue in international waters, they don't pay hardly any taxes. So you can see that their taxes on average are 2 or 1%. So what I just said is whatever last year's average tax rate was going to be, I'm going to roll forward with that. It turns out it was 1.73%. So I just apply 1.73% against income before taxes to get my income tax expense. I then subtract the income tax expense from the income before taxes, and that gives me my forecasted net income of $2.55 billion. Now, that shows you how to do it. So we've talked about doing percentage of sales for an account. I showed you a very thorough example with the CapEx waterfall of how to use judgment to estimate an account on the income statement. Now that we've forecasted our income statement, I want to revisit EBITDA to make a point. If you look at my forecasted income statement, you'll see I'm forecasting operating income of $2.8 billion and depreciation and amortization of $1.8 billion. That means my EBITDA for 2017 is being forecasted at $4.7 billion. How does that compare to the 2016 actual EBITDA? And you can see that even though I have forecasted that sales will increase, I've actually got EBITDA going down. What's the primary reason for this? Why is my forecasted 2017 EBITDA lower than my 2016 actual EBITDA? Well, I'm not going to work you through all the numbers. I'm just going to point out the primary culprit is fuel expense. In 2016, fuel expense was only 5.6% of sales. I'm forecasting in 2017 that it's going to be 6.8% of sales. That's having a fairly significant impact. So what's the takeaway? I would actually, based on what I see here at the very end of this, I would probably go back in and try to spend a little bit more time thinking about my fuel cost forecast. Well, I hope this has been helpful for you. Again, we've got a separate module showing you how to think about forecasting revenue. Once you have your revenue forecast, you want to apply this percentage of sales methodology to get your costs forecasts. Then you'll have your pro forma income statement, which is going to require a pro forma balance sheet and a pro forma cash flow statement. Once you have all that, you'll have everything you need in order to figure out your operating cash flows, net capital spending, and increases in net working capital, which will then give you your free cash flows to the firm, which you can then discount and penalize to get your intrinsic value. Remember, theoretically, you're going to give it a higher penalty or discount for cash flows that are further in the future or more uncertain. Also, quick reminder, two basic methodologies for forecasting costs: percentage of sales or using your judgment. Percentage of sales is simple. Using your judgment, I can't give you a recipe for that. You have to use your business acumen. You have to use data and information in the 10K. You might have to use some industry data. You might have to use some data that's available online. You really do have to use your judgment. But hopefully that demonstration of creating a CapEx waterfall and depreciation schedule, hopefully you found that beneficial. What I'd like to do now is a practice exercise. And here is the practice exercise. I want you to outline how you would construct a capital spending and depreciation schedule waterfall. So let's call it the waterfall. So a capital spending waterfall and a depreciation schedule for next year for Seagate Technologies. The ticker symbol is STX. Now, don't try to gather all the data and execute the forecast. Just outline your strategy for forecasting capital spending and depreciation. What method would you use? What data would you need? How would you go about arriving at your forecast? Go ahead and take a few minutes, think through that, start the video back up, and we'll show you how we do it. Okay, so hopefully you've had a few minutes to work through this exercise to create your own CapEx waterfall depreciation schedule for Seagate Technologies for the next year. I'm going to move to the computer screen here and show you our Excel spreadsheet for how we did this. And again, a little bit more sophistication when it comes to depreciation estimation. Okay, so what I've done is I've pulled up some information for Seagate Technologies, and you can see we've got historical sales for 2014, 15, 16. We've put in our sales forecast for 2017. Again, that's a separate module. And forecasting CapEx, we actually used a simplified method for forecasting CapEx, but a more sophisticated method for depreciation. We noticed that for the last 3 years, capital spending has been 4.1, 5.4, and 5.3% of sales. So we're making the assumption that CapEx as a percentage of sales will remain sort of constant at 5.5% moving forward. So the way that we're going to get our forecasted CapEx is by taking our sales forecast times our 5.5%. Now what we're going to do is create our PP&E, our net PP&E schedule. So the ending net PP&E from the balance sheet for Seagate Technologies in 2016 was $2.1 billion. So that's our beginning net PP&E. Here are our CapEx forecasts for the next 5 years, and then we need depreciation expenses. If we take our beginning net PP&E, add the CapEx, subtract the depreciation, that's going to give us our ending net PP&E for our balance sheet. We have to make some assumptions, a couple of assumptions. We're going to assume that this existing $2.1 billion of net PP&E that's already on the balance sheet has a remaining useful life of 6 years. So you can see us depreciating that existing net PP&E straight line over 6 years. Next, we're going to make the assumption that any new capital spending, any new PP&E is going to be depreciated at over a useful life of 5 years straight line using a mid-year convention. So what we do is come down and we create our own CapEx sort of depreciation schedule. What's happening here is we're saying that we're adding, if you remember from back up here, we're adding $536 million of CapEx in 2017. We're going to depreciate that over 5 years using a mid-year convention. So there's one half of the first year, there's the full 4 years, and then there's the remainder of the half year. We're going to do the same thing for the CapEx that we anticipate in 2018. In 2018, we're anticipating $521 million. We're going to depreciate that over 5 years, but using the mid-year convention, which stretches it to 6. We just do that for all of the new CapEx. But what that means is, for instance, in the year 2021, we have straight line depreciation of the CapEx from 2017, straight line depreciation of CapEx from 2018, 2019, 20, and 21. So in order to get the depreciation expense forecast in 2021, we have to add all that up. So we do that. We add up the depreciation expense for each of our 5 forecast years. Then we can bring those depreciation expense forecasts back up into our net PP&E table right here. If we take the PP&E table, so again, we started with 2.1 billion, then in 2017, we're forecasting additions of 536 million. We subtract out our depreciation expense of 402.1 million, and that gives us total net PP&E of 2.293 billion. I should also add the depreciation expense down here includes both the depreciation of all of the new CapEx plus the depreciation of the existing CapEx. That's all being added to get this total depreciation expense. So that's just a simple example of how you could forecast your CapEx waterfall for Seagate Technologies, come up with your depreciation schedule, and then from there you would have your depreciation expense for your income statement, and you would have your PP&E for your balance sheet. All right, so that's today's module. We hope that it's been helpful for you. Again, our focus has been forecasting costs on the income statement. Obviously, you have to forecast sales before that. Check out the other module for that. Today, we wanted to introduce you to percentage of sales forecasting. Hopefully, you got comfortable with the percentage of sales method, both forecasting accounts that would be percentage of sales and those that would require judgment, especially the CapEx waterfall and depreciation schedule. We wish you the very best of luck in your careers as analysts. Thank you.